I am very pleased today to be joined by our Chief Investment Strategist and Lead Portfolio Manager for the high-profile discretionary programs at IG Wealth Management, Philip Petursson. Welcome, Phil.
Thank you, Tom, and thank you, everyone, for joining today. Look, it's been a very challenging couple of weeks to couple of months in the marketplace with respect to equity market volatility, fixed income volatility, and the political landscape in the United States, to be honest with you. And we've seen a lot of differing policies that are coming and going. So what we want to do is just a level set where we are today, what's transpired up to this point, where we are today, what's transpired up to this point, where we are today, what's transpired. And so in just starting, one of the top questions that we get, myself and my team, is how can President Trump unilaterally enact tariffs like he has in the United States against countries, allies like Canada and Mexico, countries like China, areas like Europe, and so on? Well, there are a number of rules or legislative acts in the United States that allows for the implementation of tariffs for any number of reasons, but typically it results in the declaration of a national emergency or sensitivity to an industry that is important to the United States. And so we just highlighted the four key measures that Trump can use in order to put tariffs onto imports coming from other areas around the world into the United States. And this is why when you listen to what he says or the people around him, they talk about national emergencies, whether it's the fentanyl crisis in the United States, which was the justification for putting tariffs on Canada and Mexico, as well as an additional 20% tariff on China. Or they talk about other national emergencies with the deficits being a significant emergency. Now, it's the declaration of a national emergency that allows for the utilization of these various acts. And we've seen in the last couple of weeks, Congress, members of Congress have been debating in the public whether or not they want to repeal some of these or put limitations on Trump to just minimize some of the disorder, we would say, that we've seen in the marketplace. Nonetheless, it has created a lot of confusion. And what we are doing is we're following through a lot of companies, what they're saying as a result of the tariffs. So we just highlight a couple key things here. First off, corporate executives have been clearly focused on the tariffs because it does raise an element of uncertainty in terms of managing their business. And the uncertainty really stems from what is going to be the cost of importing goods into the United States from Canada or other areas around the world, or to the businesses based in Canada, what are the headwinds that businesses here might face in exporting goods into the United States? Now, as you can see, what we've done is we've scanned the corporate earnings calls and releases through the fourth quarter earnings results that came through. They come through the first quarter of 2025. And we highlight two here because we think it's quite interesting. But you can see how the number of mentions on tariffs have really skyrocketed in the first quarter. But it's not that companies are clear in terms of what they look like or even how to manage it. And so, we mentioned BRP here because it's interesting. It's an exporter from Canada into the United States. And they say, with the ongoing tariff disputes and changing geopolitical dynamics, our operating and demand environment has become much less predictable. They go on to say, we lack the necessary visibility as to the timing, nature, and extent of potential changes to trade regulations to fully assess the potential impact on our business. And this is the challenge not only in businesses in Canada, but in businesses in the United States, because the policies are changing seemingly day by day. But it's not all bad news. And we highlight what Canadian National Railway mentioned when they mentioned some of their clients, for example, the aluminum producers. And they said, we have other areas like aluminum where our customers are telling us they'll continue to ship. They're still able to be competitive even with a tariff. And so we're hearing a little bit more about this. And as first quarter earnings are being reported in the United States, we're hearing similar things, that companies aren't necessarily impacted immediately as a result of the tariffs. Their inventories are enough to sustain them through the second quarter and perhaps deeper into the third quarter. So if you believe, as we do, that perhaps these tariffs, maybe they are a negotiating tactic by the Trump administration for more favorable trade between the United States and other countries around the world, then they're going to be fairly short-lived. And that is our basic premise, in that we've been saying to our clients that while disruptive, the tariffs, we believe, are temporary. Now, when we say disruptive, we'll just highlight what has transpired in the United States with the S&P 500, the benchmark for U.S. stocks, from the beginning of the year to where we were just a couple of days ago. And you can see there's been a number of announcements out of the White House that have announced tariffs back in February, then repealed them for Canada and Mexico, where we had a 30-day reprieve, then put them back on for autos, and then repealed them for anything covered under the USMCA. Then a couple of weeks ago, put them on during Liberation Day, and then last week, we had a 90-day reprieve on the reciprocal or so-called reciprocal tariffs, winding them back to a somewhat universal limit of 10%. So there are still some tariffs out there, but following that, the market has rebounded, and we've seen the S&P 500 from last Tuesday actually up about 8.5%. So we've seen some recovery in terms of what's been going on. Now, through all of this, again, when we talk about it with respect to our clients and portfolios, we do highlight that this is more of a manufactured environment. This is not an environment that is similar to what we had during the great financial crisis, where we had, at that point, over 400 banks fail in the United States. That was what we would call a destructive event, where we had permanent loss of capital, where when banks fail, that capital is essentially gone. What we have today is more of a disruptive event, and that's we think the best way to characterize it, where it might actually be more comparable or similar to what we experienced during COVID, which in of itself was a disruptive event. It paused the economic environment, whether it be in Canada, the United States, or around the world, and we figured it out and then got past it. That's what we think is going to happen with the tariffs. If they are truly a negotiating tactic by the Trump administration, then it is going to be somewhat temporary. And we've seen the level at which Trump will start to roll these back last Wednesday, when pressured, whether it be the business community, whether it be the investor base, the donor community, the investment community. We saw Trump walk back his reciprocal tariffs, yes, dropping them to a limit of 10%, but still the message by the market was, this is not good policy. This is more disruptive to the natural flow of the business and economic cycle, and they should be walked back. So we think that we can continue to see this being walked back, as we saw over this past weekend, where the Trump administration walked back the tariffs on cell phones coming out of China, computer chips coming out of China, computers themselves coming out of China into the United States. So we're seeing an extension of policy, and then it being pulled back, an extension and being pulled back. This can be rather unsettling for investors. And when we do talk about this disruptive event and the volatility that we've seen in the S&P 500, what we also mention is to keep a level head, because in times like this, when we see the volatility that we have, investors can be spooked, and investors can react in a somewhat of a panicked fashion in this and end up selling. And so when we look at what that looks like in the United States, we've been tracking investor flows into mutual funds and ETFs in the United States, where I have data going back to the late 90s. And the bars represent the monthly inflow or outflow. It's the action by investors if they're buying into the market or selling out of the market. And that's the 12-month moving average is the dotted red line. The blue line is the S&P 500 performance on a year-over-year basis. And if you notice, what tends to happen is, as the market is weaker, investors tend to pull out of the market, out of stocks, almost coinciding with the bottom of performance of the market, and then buying back in a more meaningful way as the market responds quite strongly. And if you go all the way over to the far right-hand side, you can see This is what happened in November. On a year-over-year basis, the S&P 500 was up significantly. It was over 30% on a year-over-year basis. And in November of last year, we saw a level of buying, or frenzy almost of buying, that we haven't seen in a while. What we want to do is avoid the panic selling. And so as investors have been asking me, should we just sell everything in the United States? The answer is no. Look, our portfolio managers are doing the job to mitigate the volatility that we see in this marketplace. And in fact, as Tom mentioned, as portfolio manager for our high-profile portfolios, we took action back in November to mitigate some of the volatility by shifting to an underweight in equities, shifting to an overweight in fixed income, adding attractive asset classes like gold into our portfolios that help to reduce some of the downside risk exposure that we have. And so this is key as we see going forward. Now, I guess the question is, at what point do we start to take advantage of the volatility? And this is where we would argue, again, with the belief that this is more of a disruptive event, that we do not believe that the Trump administration is trying to engineer a recession in the United States. And as we saw last week, there is a level by which the U.S. government, the White House, will start to walk back some of their policies. We've seen over the past couple of weeks some positive response by, or last couple of months rather, positive response by central banks, whether it be in Europe or Canada, that have helped to mitigate some of that downside risk. So when we think about this, the Bank of Canada has a meeting tomorrow where they're going to announce their interest rate policy. At this point, it seems almost 50-50 whether they're going to cut or whether they're going to ease. We believe they're more inclined to maintain the overnight rate at its current level of 2.75%, which is much lower than where we were a year or two ago. And the bank, though, we believe will be ready to cut if necessary at their next meeting in June. And so we expect that the Bank of Canada will address the environment that we're in right now, address some of the uncertainty. If they cut, it's not a bad thing, but we think they're holding on to that additional interest rate cut to see where we end up with tariffs. Nonetheless, though, the bank has acknowledged that it is ready to step in and help to mitigate some of the headwinds from tariffs that could slow the Canadian economy. Again, our base case right now is that we are not headed towards a recession, that, again, this is all a negotiating tactic and will be rather short-lived. But with the acknowledgement of the Bank of Canada that they're ready to step in, that's a positive. It's positive for investors, and it's a positive for the Canadian economy. When we look at then answering the question saying, okay, given the volatility, at what point do we want to step in and take advantage of this volatility? Over the past week and a half, we've seen a number of signs that suggest we are in an environment where we phrase it as you need to hit a period of peak fear, where investors have hit that level of pessimism that they almost just can't take it anymore. And that historically has been a good buying opportunity. And we note this through a number of different ways. One of the ways that we keep track of this is through what is known as the volatility index, or the full name is the CBOE volatility index. It's otherwise known as the VIX. What we show here is that there's a level of volatility in the VIX. Its kind of more common name is the fear index. It's a measure of the sentiment by investors on the S&P 500. And when the VIX hits certain levels, and here we denote it by the blue dots, when it breaks above 30, it tends to coincide with the bottom of a correction or bear market. And that's what we note on the red lines, which is the drawdown from the 52-week high for the S&P 500. This goes back to 1990, going back to the inception of the VIX. And when we do see that level of VIX break above 30, it does tend to signal a bottoming process for a correction or bear market. And so we saw the VIX break above 30 a week and a half ago on the Thursday and Friday, or a week ago last Thursday. That does tell us that we've perhaps hit that peak fear level. Now, when we see this happen, your 1-year forward return on the S&P 500, as you can see in that middle bar on the right-hand side there, does show a positive return 87% of the time with an average return of 22.1%. So these, in our minds, are good signals to start to deploy capital if we've had it, or as we've been doing in our portfolios, start to shift some of our portfolios back into equities from the more defensive fixed income areas. Some of the other things that we look at and of note is that when we go back a week ago, this past Friday, that we saw was one of the worst days for the S&P 500, the U.S. benchmark for stocks going back to 1950. And it's denoted there, we saw a decline of 5.97% on that Friday. Now, it was the 20th worst day since 1950. And this as well is almost a positive sign. It shows that there's been capitulation in the marketplace, that investors have almost thrown in the towel, and that to us, coinciding with the VIX, coinciding with other measures that we follow, historically has been an attractive entry point back into equities. For example, when we look at the 20 worst days going back to 1950, 17 out of the 19 that we, prior to this last one, showed a positive 1-year forward return with an average of 26.6%. Only in 3 periods did we see a negative return, which was 1989, 2008. In 2 periods did we see a negative return, 1989 and 2008, where the average 1-year forward return was minus 7%, or just a little bit above that. So in our view, that gives us 3 to 4 times the upside potential versus the downside risk, with the probability of more than 80% of a positive return 1 year forward. When you look at the 2-day drop, so Thursday and Friday, which was a combined 2-day drop of 10.5% for the S&P 500, again, a week ago this past Friday, that was the 5th worst 2-day drop since 1950. This, again, is a very rare occurrence. As you can see, again, it only happened, or when we look at drops in and around this range, they are very rare. Of the 20 worst 2-day periods, we saw positive returns 16 out of 19 times 1 year forward, with an average return of 21.5%. And here we did see 3 1-year forward negative returns, being 1987, 2000, and 2008, but the drop was 6.5%. So again, we have 3 times the upside versus the downside, with a probability of just slightly better than 80%. So investors are always curious in terms of what we're thinking, how we're managing, and so on. And I'll just, before I turn it back to Tom, just wrap it up saying we truly believe that this is more of a disruptive event as opposed to a destructive event. While the volatility is unsettling, it is temporary, just like we believe the tariffs are temporary. And they do open up pockets of opportunity for us to shift what was our defensive asset allocation to take advantage of this volatility for some of the potential gains that we can see 1 year forward. So key message is, while we're going to continue to see a lot of noise coming out of the White House in the United States, and policies will change seemingly daily, when we think forward, there's more motivation for this government to steer the economy in the right direction, especially as we head to the midterms next year. And therefore, we think that this is not an environment that is going to persist. Companies will get back to doing what they do best, which is generate profit growth and manage through the various economic cycles, and we can take advantage of the opportunity in front of us. Tom, why don't I pause there and turn it back to you, and we can start taking a few of the questions.
Sure. Sounds great, Phil. Thank you very much. I thought it was interesting. I was looking at that last slide of yours, and you said on that slide, in the last 75 years, the worst drop was October 19th, 1987. And I will tell you that I had been an advisor in Calgary for 2 years at that stage. And that was a very interesting time in my life, because that was something that people hadn't experienced before. And the Dow, I think, went down to around 2,000 or just under 2,000, and today is, 40,000. So it does tell you that, certainly that the declines are temporary, and the gains seem to be go on and on and on over time. So we do have a number of questions, and I'll just pull a few out of the Q&A section here. But the first one, which is, I think, the question that a lot of people are asking is that really, what is our perspective on the Canadian versus the US dollar? And then sort of an add-on to that is that, and then how do we deal with our portfolios with that knowledge?
Yeah, it's a great question, and one that has actually been rather interesting to follow in the marketplace. So up until, say, a week and a half ago, the Canadian dollar was stuck at around 69 cents, maybe mid 69-cent range, or if you think in the inverse, it was about 140, 145, 146, somewhere around there. And so historically, the Canadian dollar and US dollar move relative to the difference in interest rates between Canada and the United States. So when Canadian interest rates are significantly lower than US interest rates, it puts a downward pressure on our dollar. And that's why we had seen a general weakness in the Canadian dollar over the past, say, year. Now, over the past week, we have seen that Canadian dollar move up just above 72 cents. Today, it's back below 72 cents, but it's moved less so in terms of the interest rate differential and more so in terms of sentiment against the U.S. and the current policy coming out of the U.S. government. And it's kind of broken away from that correlation, but that breakaway doesn't tend to last very long. We do get this over time, but historically, you get it, the Canadian dollar, US dollar cross coming back to that relationship. So we do think that the Bank of Canada is more inclined to cut interest rates, its overnight rate, than the Federal Reserve cutting the Fed funds rate. And that's going to continue to widen the gap between Canadian and US rates. So we think that over the near term, we can expect we believe the Canadian dollar will get back to 69 cents. So in that regard, we actually want US dollar exposure. We like US dollar exposure. We will pick up a couple percentage points on US dollar appreciation relative to the Canadian dollar. And by the way, this isn't just a US dollar Canadian dollar phenomenon that we've seen in the last week. We've seen a breakdown of the US dollar against the euro, the pound, where interest rates would suggest one direction for the US dollar, but it's gone the other way. So it's been a vote of foreign interests, if you will, against the US, but it's unlikely to remain in place for an extended period of time because of the much higher interest rates being offered in the US, whether it's on the corporate bond side, whether it's on the government side. And so that tells us that we're likely to see the Canadian dollar revert back to sub 70 cents, perhaps over the next coming days to coming weeks.
All right. Another question, just a slightly different path. Just in terms of asset allocation strategies, how should people be viewing their own asset allocation? Should they be reducing U.S. equity? Should they be looking at opportunities that might exist elsewhere?
It's a great question. And first, we would say, look, trust in the process and trust in our managers that have been, and myself, that have been making shifts in the portfolio along the way to reduce some of the downside and add to the upside potential. In general, where valuation is in the United States now, it's far better than where we were a year ago. U.S. stocks were much more richly valued a year ago than they are today. And so they're actually attractive today. Does that mean I would go overweight U.S.? No, we do think that there exists perhaps a better opportunity in Canada, in international markets, in emerging markets. That doesn't mean you don't own the U.S. equities, but where we've perhaps been overweight U.S. equities, and for good reason that the U.S. has performed very, very well over the last number of years, we might want to, we've been recommending trimming that back. Now, we are still underweight U.S. equity overall, but selectively adding as that opportunity presents itself. So I would say when I look around the world, the equity asset allocation is a little bit more balanced than what we might think, given some of the political uncertainty. But that doesn't change the fact that there are some great companies located in the United States.
So what about other asset classes, things like gold or commodities? How are we thinking about those?
Well, we've seen gold run very, very strongly over the past couple of years. We've been bullish on gold for the past couple of years, continue to be so. Gold I saw it break above 3,200 an ounce. And I think that there still is a positive runway for gold. As I mentioned, we do own gold in our portfolios. And I think what gold is offering now is some downside protection. If you look at what's gone on during the volatility of the U.S. equity market, what has done well? Bonds have held in fairly well. Gold has actually performed quite well in this environment. As far as commodities in general go, we've seen oil and energy commodities kind of beaten down on the potential for a recession in the United States, but we think that's still a fairly low probability. So as we look forward, we think that oil prices can move higher. When we look at precious metals, gold, we think can go higher, and then base metals as well. If you look at, Tom, think about all the AI infrastructure that's being built out right now, whether it's data centers or chips or servers and so on. It's going to require a lot of copper, a lot of steel, and we think that this sets up for an attractive environment where we don't want to get too far ahead of ourselves and say commodity super cycle, but we do see positives for the commodity complex going forward over the next year to potentially a couple of years.
Yeah. So it sounds a little bit like, but let's not take our eye off the ball of what the world was doing and is doing, even in spite of what's happening in the short term. There's still a lot of things that are happening that will benefit us. The other question I was wondering, and maybe just you talked about bonds, but how should people think about bonds? Because as a collective, there's a lot of different opportunities out there, and I'm just wondering for our audience, how do you think about bonds? How do you think about different countries and their bonds and different durations?
Yeah, look, bonds have returned to that safe haven kind of, let's call it ballast for our portfolios that they've been for the long term. Bonds in aggregate are paying us an attractive yield in the, look, if we're getting U.S. 10-year Treasury yields in the mid 4% range, corporate bonds, 1.5% above that, high yield bonds are in the 8.5% range. That's attractive. And so we think that bonds are offering investors an attractive yield that we haven't seen yields like this in quite a while, with the defensive characteristics that we hold these assets for, which is to mitigate the potential downside volatility that pops up from time to time within equity markets. So now what we like about bonds right now is that they have been that safe haven trade, and they've given us an opportunity to reduce that fixed income to take advantage of some of the equity market volatility over the past couple of weeks. So should still be an anchor in client portfolios, and utilized as such as a income stream and a source of capital for equity market volatility.
Yeah, just shifting gears here a little bit. I think this question is really interesting, and it's probably it's one of those ones where I think if you could crawl inside the head of Donald Trump today, what is his end game in your mind? Like where is he going with all of this?
Well, it's a great question, Tom, and I don't even know if he knows what his end game is. I mean, if you listen to what he says, it seems that the end game is to bring factories, bring manufacturing back into the United States, but that would really be setting the U.S. economy back decades. Returning it to the 1950s, and this is the challenge that I think that we have with his policies is that, one, with unemployment at 4.2% in the United States and manufacturing unemployment even lower than that at 2.9%, if you were, let's say, if it was feasible, which it is, you could move the factories back into the United States, but you don't have the labor force that can work the factories. There is a skill set that has been lost in the United States as a result of the globalization that we've seen over the last, call it 20 or 30 years. And so while that might be his grand vision, I don't think it's very achievable. And companies would tell you that it's expensive to relocate factories to the United States just to build them on their own. Labor costs are extremely higher than what you can see in other areas around the world. And then would Americans even want to work in these factories? So, is there some other grand scheme going on? No, I actually truly believe that this is an idea that President Trump has had in his head almost for 40 years now, and you've heard others talk about it. In an interview that he gave to Oprah Winfrey back in 1988, he talked about his love of tariffs, and he felt that the U.S. should have a 25% tariff on all imports coming in. At that point, it was directed at Japan, but it seems that this idea has stuck with them. What we know of history and economics is that tariffs are bad, right? If you put up tariffs, in the United States, it is what extended what was a recession in the United States back in the 30s into the Great Depression. When you put protectionism policies in place, it restricts trade, and it drives up inflation. Look, I think the U.S. has enjoyed substantial wealth creation over the last 20 years alongside very, very low levels of inflation, and allowed consumers in the U.S. to acquire goods that prior generations wouldn't be able to do. So, whatever his end game is, at this point, the justifications for it don't align with the realities of the U.S. economy where it is today.
Yeah. And so just maybe on a more tactical basis, we've got a question from the chat, someone asking about the notion of dollar cost averaging and averaging money into the market over time. Is that, from your perspective, still a legitimate strategy given what's going on in the world?
Absolutely, and we could argue even now. So when we talk about this being an attractive entry point, what we don't want people to take away from this is, oh, I should just go all into equities now. That's not the case. We know that we believe that we can still see some uncertainty with respect to policy out of this government. The tariffs, while reduced, are still in place to an extent, whether it's against Canada, against Mexico, or other areas around the world. So the problem hasn't been completely solved, which means the volatility may not be completely over. So dollar cost averaging, which is making purchases into equities on a frequent basis, whether that's weekly or monthly over a period of time, continues to serve investors very, very well. Takes advantage of the volatility that we may see. But also, the other key thing, Tom, is that if we have a pool of capital that we have intended to be invested in the equity market, rather than waiting for the perfect time, which may never fully show itself, meaning there is no sign that says now is the perfect day to invest, we can be paralyzed by waiting for that sign and miss great opportunities as the market, we would say, melts up. And then next thing you know, you're 20% behind. So staging into the market over a period of, say, 6 months or a year or whatever is suitable for an investor's time frame ensures that at some point we will be fully invested. And then we think about this for long-term investors, right? What is the worst day to invest? The worst day to invest is when the market is at its peak in the given year. The best day to invest is when the market is at the ultimate low. Now, trying to nail that is a 1 in 250 shot, meaning there's 250 trading days in the year, right? So if you're trying to pick the absolute best time to invest, you got a 1 in 250 day shot to do it. I don't feel confident in those odds, so I'd rather stage in over time and take advantage of the weekly volatility that we can see. Even if the markets go up, we'll be fully invested at some point, ready to take advantage of the continued gains that we would see in equities over the long term.
Yeah, no. So in effect, the best time to invest is when the market's at its lowest, and without that foresight and the ability to determine that, then averaging it over a period of time seems to make sense from your perspective. I've got another question here around the U.S. dollar, and this is really around what is, in your view, what's the potential that actions such as this lead to sort of the loss of the U.S. dollar as a dominance in trade? Like, is there a risk to the U.S. that the USD is no longer that reserve currency that exists in the world today?
Yeah, it's a good question, and one that we've been thinking of as a team as well. It's that could the U.S. have done irreversible damage to its relationships around the world or as its status as a reserve currency? And here, too, a lot of the policies don't seem to make sense. Trump wants a weaker U.S. dollar. Well, that would kind of go against the idea of the U.S. dollar having that reserve currency status. You can't have both. So is it something that could happen at some point down the road? Yes. Is it near term? No. It's highly unlikely that it would be near term. And the reason being is there's nothing to replace it. So you have to think about it in terms of global trade. It's approximately 80% of global trade is done in US dollars, right? So what would the world turn to if not the US dollar? What amount of currency exists out there that can replace the US dollar as that basis of trade? And there's really nothing there yet. Down the road, could there be something to replace it? I don't think it's a BRIC currency, which is Brazil, Russia, India, and China. The reason being is to hold reserve currency status. Historically, that currency needs to be free floating. There needs to be a certain amount of trust that's on towards the government that's backing that currency, and I don't know if we have that trust for Russia right now. So it's unlikely that we would see a BRIC currency displace the US dollar anytime soon, and it's unlikely that there would be anything else. What's likely going on right now is this kind of negative sentiment towards the US and US policies that, yes, is weakening the US dollar, but we think it is more temporary than permanent. And we can see, at least over the near term, that US dollar strengthen, whether it's against the Canadian dollar or whether against other global currencies. Down the road, certainly, is something that's going to happen in the next year to 5 years. Very low probability that's probably that could happen.
Yeah. So I think we've answered most of the questions that are in the chat that have been brought forward to me. Just want to, on behalf of everyone that's been listening, thank you very much, Phil, for sharing all of your experience and certainly all your insights with us. I want to thank all our clients and their guests that joined us today. Certainly appreciate them taking the time to listen to yourself and myself today. As I mentioned at the top, if people have follow-up questions, anything that we discussed today, feel free to reach directly to your advisor. You can certainly request a follow-up meeting by clicking on the IG icon button below. If you want to review today's webinar, so if you want to go back over Phil's comments and look at some of his slides, there is a recording available for playback, and you can use the same link that you registered. There's also, as you'll see, a QR code on the screen, and that will take you directly to our website and the Living Market podcasts that are produced on a frequent basis by Phil and his team. So with that, thank you very much, Phil. Thank you to all of our guests, and have a wonderful day.
Thank you, Tom.